How's it going today, guys? So I have to say, I am really excited about this video because it's something that I've always had a decent understanding of, but I've never fully grasped the idea of short selling a stock, simply because I've never done it. I don't think I ever will, but I really wanted to talk about it because I feel like there's so much confusion out there as far as the theory behind short selling a stock. And my goal with this video, guys, is I'm hoping that anybody who watches this video, by the time you're done with it, you could go explain this to anyone. I'm trying to make it as simple as possible, and I wish I could lay this board out better, because there's certain things I wanted to add, but I just couldn't fit it on there, and I tried to work it a couple different ways. But this is like the best way I could do it, is like to have a pictorial diagram here, have some notes on my paper. So I really hope I'm delivering this in the best way possible. But that's what my hope is, guys, is that by the time you're done watching this video, if you didn't understand short selling before, you understand it now. So make sure you guys let me know at the end if I've achieved that, and if not, I might even redo it, because I really want this to be like the best video on short selling as far as the very basics of it. And I'm probably going to do a couple videos on this because it's a very popular investment topic, and I've had a lot of people ask me about it. So I'm going to do another video on like the main risks of short selling. But this is basically just how it actually works in a very simple way. So if you're looking for a more advanced video, this is probably not the video for you. This would be like the video if you don't even understand what short selling is. This is where you should start. So basically, guys, let's start off by looking at a traditional stock investment and how that basically works. So with a traditional investment, you have a company, you have a stockbroker, and then you have you, or the investor. So basically, the company is going to offer shares to raise capital. And generally those are offered up and then they're traded on a stock exchange through a stockbroker. And basically your stockbroker facilitates the buying and selling of those shares. And then you, as the investor, you buy a piece of ownership of the company through a broker or directly from the company. Now an example of this would be if you're buying it through a stockbroker. Those are shares that are traded on the stock exchange. Or if there's no stockbroker involved, maybe you have employee stock options and you're able to get shares of a stock in the company you work for without paying commission and without going through a stockbroker. So that might be an example of how you're getting shares directly from the company, is if you're an employee of that company. But basically, you buy the shares, or you buy the shares through your company, or you buy them on the exchange, and then you own the shares and you own a piece of that company, and that is a traditional stock investment. That's what's called a long stock investment. And when investors go long, you're basically anticipating a price rise in the future. It's what's called a bullish investment. You're betting on the stock to go up in value. And that's where they get the name short from, because when you're long on a stock, you're betting on the price to go up, and when you're short on a stock, you're betting on the price to go down. You're anticipating a price decrease in the future. And that's a bearish investment as compared to a bullish investment. So bearish investors make money from falling stock prices. Bullish investors make money from rising stock prices. And most traditional investing is a bullish investment. Bearish is kind of a more advanced investment. Many people will disagree with that statement, but just from what I've seen and the people I've talked to, most advanced people are doing short selling. I'm not saying that you as a beginner couldn't short sell. Basically, the principles are the same. You're just kind of doing it in a different way. But there's a lot more risk associated with a short sale. And maybe at the end of the video, you'll understand why that is. But I don't want to get too deep. I just kind of want to get through the theory of this. So anyways, that's a traditional stock investment. You're buying a piece of ownership of the company, either through a stockbroker or through the company directly. And then you're part owner of that company. You're betting on that stock to go up in value. You're bullish on that investment. Now let's look at short selling a stock. There's a little more going on with short selling a stock. And basically, what is short selling a stock? Well, when you short a stock, you're basically betting against that stock. You're bearish on that stock. You're betting the price will go down in the future. And short investors are bearish, and they make their money from falling stock prices, like I said. A short sale is the sale of a security that isn't owned by the seller, but it is promised to be delivered. So you're basically selling borrowed shares. And I'm going to explain to you guys exactly how that works in this diagram here. And it actually makes it pretty simple. We're going to go through the steps. So first of all, step one is the broker lends you shares. And this is in a margin account. So this can't be a traditional trading account. It has to be a margin account in order to short sell. Anyways, the broker lends you shares. You essentially borrow the assets. So here's your stockbroker. He lends you these assets and you become the short seller, okay? So the stock comes from the brokerage inventory, or it comes from a customer, or it comes from another stock brokerage. So it depends, but they do have to have those shares. They at least need to have those shares available to cover, but they need to have the availability to get those shares, or they need to be holding those shares in their inventory. Step number 2 is you sell the borrowed shares on the market. So essentially, right after you borrow these assets from your stockbroker, you sell them on the market to a buyer, okay? And then the shares are sold to a buyer and the proceeds are credited to your account. But at this point, you never owned those shares. You borrowed those shares, and because you did this in a margin account, you're now going to pay interest until the short is covered. And by cover, what we mean is to close the short by buying back the shares and hopefully buying them back at a lower price at a later date. So you've now basically borrowed the shares from your broker, sold them to the market, and now you're sitting there paying interest on that margin account until you buy back the shares and cover that short. So step number 3 is to buy back the same number of shares from the market at a later date, hopefully at a lower price. And then at that point, once you buy back those shares from the market, you return those assets to the stockbroker who originally let you borrow them, as well as any interest that you've been paying along. So what the stockbroker gets out of this is interest. They let you borrow these shares in return for interest. What you get out of it is hopefully a price difference between what you borrowed the shares for and then what you bought them back for. So let's look at 2 examples here. Example number 1 would be you're buying the shares, number 2 here, so you're basically, let me look here. You borrowed the assets, okay, and the shares sell for $20 a share. You sell the assets for $20 a share, okay? Time goes by, and then you essentially buy the shares back from the market at $5 a share. Well, this $15 here in orange, that's all your profit, because that's the price difference between what you sold the shares for and then what you bought them back for. Now, in a not so good situation where you shorted a stock and then the stock went up in value and you had to close your position or basically cover your short, that would be where you bought your shares. Okay, so basically you got your shares from your broker, sold them for $5 a share to a buyer, then the stock price went up, and then you had to cover your short and buy them back from the market at $20 a share, meaning all this blue area here is how much money you've lost. Now maybe you're starting to see the big danger with shorting a stock, but we'll talk about that in a little bit because there's a few more things I want to mention with this. First of all, after step 2, 2 things can happen. One of them is very uncommon, but it is something to understand that this is something that your broker can do. Once you're, I'm on the wrong side of the page here. So what happens after step 2? So after you sell the borrowed shares and you're basically just paying interest in your margin account for those borrowed shares, 2 things can happen. Number 1 is that you hold the short as long as you want and just pay interest because it's a margin account. Obviously, the longer that short is, the more you're paying in interest. The second thing that can happen is that investors can get called away when the broker asks for shares back or money to cover them, as well as any dividends. While this is a very uncommon scenario, it has happened in the past, and it's very common when there's many short positions on a stock. So it's possible that you could be shorting a stock, okay? The value of the stock goes up, it goes against what you expected, and next thing you know, you get called away from your broker to the point where you either need to buy those shares or come up with the money to pay for those shares at the current market value. And that's where you can potentially lose a ton of money. So those are 2 things that can happen after step 2. You either hold the shares, or basically you hold the position and you pay interest, or there's a possibility that you'll get called away and you have to basically come up with the money or the shares at that point. And that's going to be money from somewhere else, either if you have shares in your account that you can liquidate or you're putting money into your trading account. So that's not a good situation to be in for sure. But anyways, next we're going to be going over 2 scenarios of a good day on a short position and then a bad day with a short position. All right, now the last thing we're going to look at here is short selling on a good day and then short selling on a bad day. And let me just say, guys, short selling on a good day, that can be a very good day for you. When I'm saying a good day, it takes longer than a day in most cases. But when you're having a good time short selling versus having a bad time would be a better way to describe this. But when you're having a good time short selling, let me tell you, it can be a great time and there's a lot of money to be made. But when you're having a bad time short selling, it's a bad time in most cases. So let's walk through the numbers here just to get an example of this. So you're having a good time short selling. ABC stock is $100 a share. You believe that the stock is going to go down, so you have a short position of 1,000 shares, and in your margin account, that's 50%. Basically, you have to have 50% of that, so $50,000 invested, $50,000 on margin. So that's how you have your $100,000. You have $50,000 basically on loan from your broker. So your total short position is $100,000. 1 year later, ABC stock is now trading at $10 a share. You were right, the shares just plummeted in value. So you basically now cover at $10,000, or basically buy back 1,000 shares at $10 a share, and then you pay $2,500 in interest, basically 5% interest on a margin account for 1 year. And so your profit would be $100,000 minus your $10,000 cover, minus your $2,500 in interest. So your profit is $87,000 or $87,500 on a $50,000 investment. You're pretty happy with that investment. That is a great return. But let's look at what happens when you're wrong and you short a position and it goes against you. So ABC stock, $100 a share. You short 1,000 shares again. 1 year later though, ABC stock is at $250 a share. It didn't go down in value, it went up in value. And now all of a sudden, your broker decides to write a call order and basically call in those shares and say, hey, give me the money or give me the shares. At this point, you buy back 1,000 shares at $250 a share for a total cost of $250,000. You pay $2,500 in interest, so your profit is $100,000 minus $250,000 to cover minus $2,500 in interest. So wait a second. All of a sudden, on a $50,000 investment, you lost $152,500. That is the danger of shorting a stock, guys. Your losses are infinite. You can lose an infinite amount of money. If the stock was $500 a share, it would be double that. It would be $300,000 plus the interest. You can lose an infinite amount of money when shorting a stock. And that is why shorting can be very dangerous, and you really need to know what you're doing. While the gains can be wonderful and fantastic, you can make a ton of money, you can also lose an unthinkable amount of money when you're shorting stocks. And I know these numbers probably don't make sense, but just for example's sake, I wanted to use them to show you guys how much you could potentially lose. Ideally, somebody who was in a short position like that, I'm sure they would have covered their position long before that stock climbed to 250. So, it's all based on your strategy. But it just goes to show, guys, your losses are infinite. There's an infinite potential to lose money when you short sell a stock. And that's just what I wanted to show you guys right here. Anyways, guys, like I said, this was a very basic video on just the theory behind short selling stocks. And I'm planning on doing another video, probably a couple videos on short selling. One of them is going to be what risks are involved with short selling a stock, because there's more than one. It's not just this infinite loss of money. I want to go through those other risk factors involved. That'll be another video, though. I didn't want to drag this thing out too long. But if you guys enjoyed this video, please leave me a comment. If this was explained well, please let me know as well, because if not, I would consider redoing this, because I really want this to be a great video on short selling stocks. So make sure you guys provide me with your feedback. If you have any ideas for future videos about short selling stocks or any of the topics I cover on this channel, drop me a comment as well. I would appreciate it if you drop a like on this video if you enjoyed it. And if you are new to the channel, please subscribe to be notified of any future uploads. And as always, I thank you guys for watching this video.